Ladies and gentlemen, good day and welcome to the earnings conference call of Apeejay Surrendra Park Hotels Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Devrishi Singh of CDR India. Thank you, and over to you, sir.
Thank you, Sagar. Good afternoon, everyone, and thank you for joining us on Apeejay Surrendra Park Hotels Q1 FY26 earnings conference call. We have with us Ms. Priya Paul, Chairperson, Mr. Vijay Devan, Managing Director, Mr. Atul Khosla, SVP Finance and CFO of the company, and Mr. Rabindra Basu, Director, Investor Relations. We will begin the call with opening remarks from the management, followed by an interactive Q&A session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Ms. Priya Paul to make her opening remarks. Thank you, and over to you, ma'am.
Thank you. Good afternoon, everyone. On behalf of the board and management team at Apeejay Surrendra Park Hotels, I extend a very warm welcome to all of you to our Q1 FY26 earnings conference call. This quarter marks another step forward in our journey of shaping distinctive hospitality experiences and reinforcing our leadership in the boutique, luxury, and upper upscale segments. We have built a portfolio based on our vision of leadership through differentiation, creating brands that resonate strongly with loyal guests across India and beyond. In Q1, we strengthened our presence in the high-potential leisure destinations by signing an MOU to acquire and manage 4 properties in Goa, Manali, Simla, and Dharamshala. These additions will broaden our geographic reach and enhance our positioning in some of India's most sought-after tourism markets. Our investment in Mumbai, which was announced earlier, will result in a quick entry into this very important market. Our new projects in EM Bypass, Kolkata, Visakhapatnam, and Pune are progressing well, with key permissions in hand and design work almost complete. We continue to scale our asset-light side of the business across brands from the Zone by the Park, Zone Connect, as well as the Park. The macro backdrop remains supportive despite a few hiccups in Q1, but India witnesses sustained growth in both leisure and travel and business travel. The supply and demand mismatch continues in the next few years. And in the meantime, infrastructure upgrades, tourism-friendly policies in governments, and rising consumer aspirations are driving demand across the country. These factors, coupled with our strong brand equity and market reach, place us in a position of strength to capitalize on the opportunities ahead. Looking ahead, our focus will be on executing our pipeline of strategic projects, deepening guest engagement through curated experiences, and continuing to innovate across our portfolio. Our team is committed to creating enduring value for all stakeholders by staying true to our vision and mission. I am delighted by our excellent Q1 performance delivered by our outstanding team across the country. Innovative food and beverages, industry-leading occupancy at 92% continue to be the cornerstones of our success. None of this would be possible without the continued support from our team, our customers, partners, and shareholders. Thank you all. I now hand this over to Vijay Devan, Managing Director of our company, who will take you through the performance of Q1. Thank you very much.
Thank you, Ms. Paul. Good evening, everyone, and a very warm welcome to all of you. We truly appreciate you joining us on today's earnings call. On behalf of my entire leadership team, I would like to express our heartfelt gratitude for your continued support and belief in our vision. Your confidence continues to energize our journey, and today we are pleased to share our quarterly performance and meaningful progress on multiple fronts. We have commenced FY26 on a very strong and encouraging note, and thanks to the dedication and commitment and hard work of our teams, we have delivered an extraordinary and best ever Q1, setting a strong momentum for the year ahead. At the operating level, the company recorded a top-line growth of 14% and an EBITDA growth of 16%. We recorded India's highest occupancy of 92% and maintained our leadership in RevPAR in the upper upscale segment. During the course of the quarter, ARR improved by 13% and RevPAR increased by 12%. Powered by accelerated increase of close to 600 rooms, which includes 41% increase in the asset-light side of the model, a nationwide Flurys rollout, we are now set to scale faster, protect and improve our margins, and deliver exceptional shareholder value. Our flagship properties, starting with Calcutta, achieved full occupancy of 100%, while Chennai posted 95%, and both Navi Mumbai and Bangalore recorded occupancies of 93%. This performance is a testament to our consistent focus on service excellence, operational efficiencies, differentiated hospitality offerings, and customer loyalty. FY26 will see addition of close to 600 rooms, 411 rooms in the asset category of management contract, 147 rooms in lease category, and 31 rooms in the ownership category. Total number of rooms will increase from 35 hotels with 2,394 keys to 50 hotels with 2,983 keys, in line with our vision of 50 hotels by 2025. These additions, aided by organic growth, will lead to sustained high double-digit growth in both revenues and EBITDA. Our balance sheet is extremely strong, with net worth standing at 1,297 crores. ICRA rating remains stable at A+, and with deposits close to 70 crores, the liquidity situation in the company is extremely comfortable. FY26 will see conclusion of two strategic acquisitions, 80 rooms, Zillion Hotels and Resorts at Juhu for 90% stake at 206 crores to be concluded within this month, and 31 rooms at Cochin at a cost of 62 crores to be concluded by the end of September. These two strategic acquisitions will strengthen our position both in business and luxury segments. Our development plans remain on course. FY26 will see the launch of our EM Bypass Calcutta project in collaboration with the Ambuja Neotia Group. This development, structured under a joint development agreement, will see ASPHL receive 55% of the project revenues. The sale of the residential apartments is expected to commence around the Diwali season this year, making the formal kickoff of the development. The total project is expected to generate over 600 crores in revenues, with our share expected to contribute 100 crores per year over the next 3 years. These cash flows will be reinvested into the project, enabling us to efficiently progress towards our goal of completing both the residential and hotel components by April of 2028. With no capital investment beyond our historic land bank, the project is poised to deliver strong ROCE and emerge as a landmark asset in our portfolio. As you are aware, in the previous financial year, we launched two Heritage Palace properties, the Lotus Palace Chettinad and Ranbasta Palace at Patiala. To share an update, the Lotus Palace recorded an ARR of close to 12,000 rupees in Q1 of FY26, while Ranbas achieved an ARR of close to 25,000 rupees. We expect ARRs at Ranbas to improve further as the property stabilizes. Our iconic bakery and confectionery brand, Flurys, continues to expand its footprint steadily. As of June 30th, 2025, we operate 102 outlets across formats, including flagship cafes, kiosks, and tea rooms, with recent openings in Darjeeling and Gangtok. We plan to accelerate store additions over the remainder of this year and into next, targeting 200 stores by 2027 to coincide with the centenary year of Flurys. The expansion remains a strategic priority for us, aimed at broadening market presence and catering to a diverse customer base while blending contemporary amenities with rich cultural heritage. In the coming quarters, we will continue to focus on opening high-margin cafe formats and driving store-level profitability. We continue to target annual revenues of 1 crore for mature outlets, and we are encouraged by the traction achieved across recently launched locations. Looking ahead, our long-term strategy remains anchored in the 3G framework of growth, governance, and green. Sustainability continues to be a core focus area for us, with initiatives in water efficiency, carbon reduction, and responsible waste management. As of June 30th, 2025, 4 of our hotels are IGBC Green certified, reflecting steady progress towards industry-leading green standards. The company, during the course of this year, will be spending around 15 crores in technology and AI to improve efficiencies and performance. Web check-ins, customer identification, chatbots, AI concierge are all under implementation. Flurys will have a new billing system and a loyalty program, as well as self-ordering kiosks. AI-based SAP SH4HANA ERP is also under implementation in our company for financial accounting, cost management, and better compliances. We continue to invest further in our revenue management system, which now have generative AI to lead the market, and this has been our biggest strength to achieve high ARRs and high occupancies. As we progress through FY26, our business fundamentals remain strong, the development pipeline is advancing well, and our strategic roadmap is anchored in a prudent capital structure and disciplined execution. Having delivered sustained double-digit growth in FY25, we are confident of achieving high-teen growth in both revenues and EBITDA in the years ahead. Backed by resilient demand, improved pricing power, steady portfolio expansion in the premium luxury segment, and continued leadership in the upper upscale segment, we are well placed to capture the opportunities ahead. Once again, I extend my heartfelt gratitude to our shareholders, customers, team members, and business partners for their continued trust and support. Thank you. I will now request the moderator to open the line for question and answers. Thank you again.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star, then 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Again, to register for a question, please press star, then 1. Our first question comes from the line of Archana Gude from IDBI Capital. Please go ahead.
Hi, good evening, everyone. Thank you for the opportunity. I have a few questions. First on Flurys. Sir, I recollect we had given number of flurries addition was at 50 on annual basis earlier, and this has come down to 40 outlets as per Q1 presentation. Can you help us understand what has led to lowering this guidance?
No, it's not that we are lowering the guidance. It's the reason behind this, of course, for this year is to actually move away from kiosks to cafes. And obviously, the investment level has been kept at the same level because for us, the cafes cost more more than the kiosk. So in terms of the spend, in terms of the development, that remains the same, which adds up to 40 as per our planning for this year. So we will open 40 stores as per the plan this year, and then we plan to open 60 stores in the coming year to reach the 200 mark by 2027, which is the centenary year of Flurries.
Right. So you're saying instead of having 50-50, we'll be having 40 this year and maybe 60 next year. Right,
No,
sir?
so what will happen is that the mix of cafes and kiosk is going to change more in favor of the cafes, and this will lead to actually higher revenues for us than by opening just the kiosk. So this fundamental change has been done to actually improve performance and improve results.
Okay.
Because the cafes are more profitable to us.
Right. So on the
obviously, and still keeping the costs within what was budgeted.
Right. So on the sales part, if I look at the flurry sales this quarter, of course, there has been pretty healthy growth on YOY, led by your higher stores. But when I look at on the sequential basis, it has gone down by 6%. So, what has really changed in last quarter to this quarter?
No, the growth in Flurry's top line has been 42%. Currently, we have 102 outlets. Most of the outlets, if you will recall, opened towards the end, towards the third, quarter 3 and quarter 4. And because of these additions, right now you're seeing 42% growth in top line. But our store-to-store growth, that is existing store growth, is well above the 11% mark in most of the stores, and some of the tea rooms, the growth is as high as 15%. So the same store growth is also very strong, and the tea rooms same store growth is even stronger.
Right. So my question was more of on a sequential basis, sir, on QOQ. In the absolute number.
So we have done last on Y-on-Y basis, we did 16 crores last year, and this year we have done 19 crores. Because the quarter 1, again, as you know, in terms of the hospitality business, the hospitality business is very cyclic in nature. The best results come only in quarter 3 and quarter 4 during the festive season. But on a quarter-to-quarter basis, the growth has been 42% from 16 crores to 19 crores. And last year we had done total revenues of 64 crores. And this year, with the opening of 40 outlets and organic growth, we expect the revenues at Flurries to be in the range of 85 to 90 crores.
Mm-hmm. Right, sir.
And you can Q4 and Q1 cannot be sequentially compared. So that's why I know you are saying that 16 crore is almost same as the Flurries. That's what your query is, no? So that growth will keep on coming. If 16 crore is of this quarter is to be compared with the last quarter. Same time quarter 1 25. Q4 is a Q3 and Q4 constitute about 70% of Flurries revenue. So that cannot be compared.
Okay. Mm-hmm. Right. You also spoke about the matured Flurries store giving 1 CR as net sales. So how many we had in this Q1 FY26, the mature stores, and how that should pan out, let's say, by end of FY26?
So FY26, as I said, we will be reaching about 85 to 90 crores, and we should be heading for about 70 to 80 lakhs by the end of this year per store. And by next year, we are absolutely confident that all these stores will be in the range of 1 crore or 1 crore plus. Currently, we are at 60. Last year, we were at 64 lakhs.
Mm-hmm. Correct. So maybe, one more on Flurries, and then again, I'll join the queue. When I look at the presentation, we have kind of, the reduced number of stores for Delhi, Bombay, and Hyderabad. While, of course, we have added a couple of more locations. So is that, we'll be changing the strategy for these markets, the Delhi, Mumbai, Hyderabad, or how we should see? I understand you spoke about changing from kiosks to cafes, and that's why the number has lowered. But still, Bombay has been doing pretty well for us. And what was the thought process behind reducing the number of Flurries store for Bombay?
No, so first thing is that Flurries has a national rollout plan which begins now with Delhi. In Delhi, as you know, what is happening is that we are setting up a large commissary. This commissary is likely to be ready by the end of this year or early next year. Once this commissary is ready, we enter the city of Delhi, and in next year the plan would be to cover the whole of North India. In the meantime, we are planning to open Flurries outlets wherever we have our existing hotels or from where we can supply from the commissaries which are in existence at the moment. So the plan is very robust, and it stays on course to expand very rapidly in North India, and then of course it has as an overall basis a national plan.
Right, sir. Sure. So thank you so much. I'll again come back in the queue. Thank you.
Thank you. Our next question comes from the line of Vaibhav Mule from Yes Securities. Please go ahead.
Hi, team. First of all, congratulations on a strong set of numbers. My first question was on our immediate expansion pipeline, which includes 147 leased keys and 31 owned keys. Can you give the breakup of asset-wise expected ARRs for these properties?
So for the 600 keys which we plan to open this year, we plan to open roughly about 141 keys in Q2, 194 keys in Q3, and 254 keys in Q4, Vaibhav. And this adds up to total keys of 589. So we plan to open 14 hotels. Typically in our zone hotels, the majority of these properties are in Zone by the Park, and our second brand in Zone, which is Zone Connect by the Park, which typically enjoys an ARR of 4,000 to 4,500 rupees at the moment, and we expect properties to be in this range.
So all the leased properties will be opened under Zone or Zone Connect, you are saying?
Yes, this is under our asset-light model of Zone and Zone Connect by the Park.
All right. And what do you think will be the margins for these properties, given the lease rentals will be a part of your expenses? So what kind of margins do you expect for these properties, and the impact on the blended operating margins?
The post lease rental, we expect around 20% to 25% is a margin. But for the purpose of blended EBITDA purpose, it will be pre-Ind-AS, so it should contribute about 30% to the EBITDA on a basis. It's 30% EBITDA, 10% is roughly the 10 to 15% will be the lease rentals.
All right. So, 30% post-Ind-AS you are sort of talking about operating margins for these properties.
Yeah, 30 to 35%.
All right. And secondly, we have given a breakup of the expected ARRs for our own expansion pipeline along with the projected revenue. So, the ARR projections are, materially higher compared to the blended ARR that we do at a company level. So what is the reason that we are expecting significantly higher ARR compared to our current, ARR run rate across the metros?
So current properties, as you know, which are 1,101 keys, are operating in the upper upscale segment in the boutique category. Of course, these properties are also getting upgraded as we are going along. But the new properties, which are roughly similar to, which is about 1,035 keys, are all coming in the premium luxury category. So that is why these ARRs are going to be much higher, and they will have a significant impact in improving our margins.
Got it, sir. And if just lastly, I can ask about the Flurry's operating margin for the quarter?
So Flurry's have done about 9% in the margins.
Flurry's margins are typically in the range.
Post is 2%.
Yeah, okay.
Sorry, I missed the last part.
9% is the pre-interest, post-interest is 2 to 2.5%.
Got it. Perfect. Understood. That's it from my side. Thank you.
Thank you. Our next question comes from the line of Sumant Kumar from Motilal Oswal. Please go ahead.
Yeah, hi, sir. Good numbers in the bad quarter where 10 days business disruption we have. My question is regarding the renovation plan we have across hotels. What are the renovation cost for the market property we have and for next 2 to 3 years?
So Sumant, thank you for your question. Firstly, on an annualized basis, to improve our properties, we have a fixed budget of about 50 crores, and we will continue to be on course to invest 50 crores on an annual basis to upgrade our existing properties. We have a cushion to considering our very high performance, which is 92% occupancy on 92 to actually 94% occupancy. It gives us only a leeway to renovate about 70 to 80 rooms, and we will continue to do that. That kind of focus will be there to renovate 70 to 80 rooms. This year, we have a similar plan. About 60 odd rooms are getting upgraded in our property in Calcutta. About 19 rooms are getting upgraded in Chennai, and about 14 rooms are getting upgraded in Visakhapatnam.
Thank you.
Thank you. Our next question comes from the line of Saket Mehrotra from Tusk Investments. Please go ahead.
Thank you. Congratulations on a great set of numbers, sir. My first question was, can we get some sense on what is the mix of revenue from management contracts for the quarter, and how do we see this scaling up for the next 2 years?
So just a minute, we are just getting you to the numbers. Of course, last year we had done 19 crores on a YTD basis.
This quarter we have done 4 crore from management contracts. Since we are signing more contracts, we expect this year to close more than 20 crore from the management contract division.
Okay. And the growth plans that we've sort of talked about, I mean, we are on track to achieve it as per the schedule, right? I hope. I mean, that's
absolutely. The company is absolutely focused in delivering the guidance which it has provided for. We had given a very strong guidance, and we remain committed to achieving that guidance.
So we are going to do 20 crore, and with the addition of this which we are signing, that should contribute another 4 to 5 crore. So we will end up at 25 expected on management contract division, including the H2 5 crores.
Okay. And just another question. Mr. Devan, in your opening comment, you mentioned about the EM bypass project to generate about 600 crores of cash flows, where you would be getting close to 100 crores a year for 3 years. So when are you expecting the flow of this to start? Is it this financial year or from the next financial?
This year, the way the residences sell, as you know, generally in the first year you take about 10% as the deposit fee. So expecting that our share will be around 30 odd crores this year, and then it rapidly moves up to 100 crores per year.
Understood. Thank you so much, and wish you all the best.
Thank you. Thank you, Rakesh.
Thank you. Our next question comes from the line of Vivek Lodaria from Nirvay Asset Management. Please go ahead.
Yes, sir. Am I audible?
Yes.
Okay, sir. My first question was, beyond outlet count growth, could you share the latest average revenue per store for Flurry? Earlier you timeline to reach 10 million per store annually. So what was the comment for that?
No, so this we did 64 crores, so it is a 2-year process at the moment. We are expecting to cross around 80 lakhs per store, and then hit about 1 crore per store sometime during the course of next year.
Okay. Or second, sir, in quarter 1 FY26, despite a full year plan for 40 new outlets, there was no new opening reported this quarter. Could you share the main reason for this pause?
No, it is, we have opened actually 4 stores at the moment during the course of this quarter. We opened stores in Darjeeling, Gangtok, a store in Bhubaneswar, and another store up north in Bengal. Also, at the same time, we have actually closed down 4 stores because this is also part of our strategy that if we fail in a store, we fill that store fast, so as to ensure that our margins remain the best. So 3 to 4 stores have been actually closed in West Bengal. So it looks that the number has remained the same, but it is not the case. Flurry's expansion plan continues to be of opening and being present across all India. So you will see larger openings very soon, and particularly in quarter 3 and quarter 4, as we come to launch our new commissary in Delhi.
Okay, sir. So what was the key reasons for those closures?
There have been low footfalls, and it appeared that we could start losing money in those stores. So based on that, it will always be the plan that inefficient stores will have to close down, So as we go along, there would always be in the range of 3 to 4% store closures will always be there. And then, of course, the expansion plan will continue as planned.
Okay. So, those two stores were making EBITDA loss.
You can't say that we are very careful about it. We do not
Okay.
want a store to go into an EBITDA loss situation. But if our analysis shows that this store is losing ground, and then we tend to close it before it starts losing money.
Okay. So, we are committed for FY27, till FY27, we are committed for 200 stores.
Yes, we are also committed not only to 200 stores by FY27. We plan to open 350 to 400 stores by FY30. That has been our plan for Fleury's, and we are well on course to deliver that.
As per this plan was very aggressive. What your thought on it?
No, but if you see our competitors also, their competitor made a plan. They also have similar plans. In last year, Starbucks has been able to open about 60 stores, and there is no reason that we will not be able to open similar number of stores, which is in the range of 40. So it is
Okay,
not. This is a very fast-growing industry, and we will be able to keep pace with our competitors.
Our execution speed will further increase once the commissary and dairy is opened, and that we have already said. So that factory can supply whole of the commissary can supply whole of the North India. So you will see 40. That's why it's 40/60. Once that's open, then it will increase.
Okay, sir. So I have to ask the last question. So how can we finance for this new opening of stores via debt or internal accruals?
It's mainly through Fleury's expansion is mainly through internal accruals.
Okay. Thanks.
So as we explained in the last investor call also, our total capital outlay over the next 5 years is about 1,700 crores. And during the course of this year, we plan to spend roughly about 300 crores in terms of the acquisition as well as the development plans of Fleury's, as well as internal development, IT. So in total, we plan to spend 300 crores this year. And overall, over the 5-year period, we plan to spend about 1,700 crores. And 300 crores, of course, we get back from the sale of the apartments. So net expansion plan would be around 1,400 crores. And that we should be able to sort of definitely meet through our EBITDA forecast for this year, as well as growth in EBITDA over the coming years.
Okay, sir. Okay. Thank you.
Thank you. Our next question comes from the line of Vikas Ahuja from Antique. Please go ahead.
Hi, thanks for taking my question. So my question is, just going back to this Fleury's, plan we have for FY25-26, and now we are calling for new, 40 new opening versus 50 last quarter. So this is net of the closures, or this is the number we are going to add, and if there are, let's say 5-6 closure during the year, so the net number would be 33, 34. Because if I look at first 4.5 months, we have added only 2 on net basis. So just trying to figure out how we will achieve this target.
No, so this number is going to be the net number. It is not a gross number. So stores are already being identified, work is going on, and the work is progressing as per plan as far as the setting of the commissary is concerned at Delhi. And we should be on course to deliver the number. And it is going to be a net number.
Yeah. So just to clarify that in next 8 months, we are going to add on net basis 38 more to reach to 140 as a total number of. Okay. Thanks. This is helpful. And secondly, we have added in terms of our development pipeline for lease hotels. Now we are talking about 441 keys. So can you explain this increase where we are kind of adding? Sorry, I mean, if I have missed it in the presentation.
So we are actually going to add during the course of this year 589 keys, out of which 411 keys are going to be on the asset-light side of the model. 147 keys are coming in the lease model, and 31 keys are coming in Cochin on the ownership side of the business. These properties are opening in Patna, Goa. These 411 properties first are and total 589, are opening in Patna, Goa. In fact, 3 properties are going to open. Dharamshala, Manali, Shimla, another property in Calcutta, which is other than the properties we have. We have Katra in J&K, Gangtok, Malabar. Malabar is going to be the ownership property. Darjeeling, Lucknow, Jim Corbett, and Gangtok. Gangtok is actually going to see 2 properties, one opening in Q3 and one opening in Q4. So a total of 14 hotels are going to open with 589 keys. And we still have time to sign more keys in the remaining part of the year. So that is why I said that we should be able to open close to or above 600 keys during the course of the year.
Okay, thank you.
Thank you. Our next question comes from the line of Raman KV from Sequent Investments. Please go ahead.
Hello, sir. Can you hear me?
Yes, we can, Raman.
Sir, I have a doubt with respect to the earlier comment. You said you will be opening around 589 keys, out of which 489 keys will be asset light and 149 keys will be lease, right?
411.
Okay, 411. Okay, 411 will be asset light, 149 will be lease model.
147 is leased and 31 is ownership.
Okay. And sir, yes, sir?
That makes it 489. 589.
Oh, yeah. Sir, and my second question is with respect to the acquisition. You have acquired Zillion Hotels, 90% stake, which has a hotel in Bombay of 80 rooms. So I just want to understand what's the revenue potential, or how much revenue was the hotel able to do in FY25?
So firstly, this deal is, we have signed a binding MOU for the acquisition of Zillion Hotels and Resorts. Currently, it is 60 residences, 60 service apartment, not residences. This will be converted into a 80-room super luxury boutique hotel. It will have 80 rooms and suites, and it will have, of course, a rooftop bar and restaurant and an all-day dining restaurant. This is how the plan is for Zillion. Currently, we are acquiring 90% stake for 206 crores, and we plan to spend about 60 odd crores for the refurbishment and development and renovation of this hotel. So as we acquire this hotel, as it comes to us in the month of August or beginning of September, then we start the process of renovation, and we should be able to deliver this hotel to all of us by H2 of next year. Our stabilized year of forecast for this property, that is not next year, the year after that, would be somewhere around 60 crores and giving EBITDA margin of anywhere between 24 to 28 crores in the stabilized year of operation. I do expect this property to give somewhere around 20 to 25 crores next year and add about 6 to 7 crores to the bottom line in the first 6 months. And I would consider 27, 28 of performance for this property. It will open certainly next year, and it will have a strong opening, but it should stabilize in 27, 28.
So, my understanding is 60 crores from this, once you are done converting this property into a luxury hotel, you will get additional 60 crores of revenue with 24% margin. So that will be in FY28.
I'm not saying 24% margin. With 60 crores, I should be able to get roughly about 40 to 50% margin. Yes, 24 to 28 crores would be my EBITDA to start with. And then, of course, as we move forward, this is a high ARR market. The current ARRs in the market are in the range of 18 to 20,000 rupees, and there is no reason we will not be able to achieve those ARRs. And in fact, with the positioning we will take, we should be able to actually command a much higher premium.
So, the peak revenue potential is 60 crores? Or
No, the revenue potential of the property would be not less than 80 crores at current market trends of 18,000 to 20,000 ARR. And then, of course, don't forget that we run one of the best bars and nightclubs in the country. We do the maximum business in terms of F&B. We do not expect the revenues, in fact, to be less than 10 crores on the rooftop bar. In fact, it could surprise everyone by doing more than 12 crores. And will also, in terms of the restaurant itself and conference facility, it will have limited conference facility. We should be able to add another 10 crores. So, all in all, the property will have a potential on the F&B side as well. So as a result of that, the overall potential should be around 80 crores to begin with, and of course then it will be subject to, it will move on with organic growth.
And sir, with respect to the second acquisition, one is the Malabar House at Fort Kochi, and another one is the Purity at Lake Vembanad. Can you, in the PPT, it's mentioned that the total cost of acquisition is 62 crores. Is it including both Purity as well as Malabar Hills, or only for Purity?
It is for both the properties, and these are all, this is a very high-end luxury resort hotels. They are part of the Relais and Chateau group, which is the marketing company, and which is highly prestigious in the hospitality business to be part of the Relais and Chateau, which is the elite luxury group. This property already, the Malabar, is already a Relais and Chateau hotel. In fact, our hotel in Patiala, the Ranbas, the Palace, is also a Relais and Chateau hotel, which automatically guarantees very, very high ARRs from their own booking engine, and because of and also provide for a very high positioning of the property in the upper luxury segment.
Yes, sir. Also, coming to that point, my understanding is this will add around 31 keys by second half of this year or next year? And what's the peak revenue are you expecting from this acquisition?
This is this year and peak revenue expected on a stabilizer after takeover. You can say next year or next year is between around 20 crores.
20 crores next year, so 10 crores this year, right?
10 crores may not come this year because when you take over, you just stabilize it. So I'm not saying. Peak revenue, I've said it will come, this year could be 8 crores.
Okay. Thank you, sir.
So adding back to this, all this which is coming up, the 600 rooms, which includes 31 rooms at Cochin, the stabilization of our Palace hotels, we are very confident that the guidance which we have given, we should be able to achieve.
And sir, just a follow-up on this, you said this is a very luxury hotel. So even this has a higher EBITDA margin, about 40-50%. So this acquisition will also help in driving the our consolidated EBITDA margin, right?
Correct. Absolutely correct. The Palace hotels as well as these two hotels in Cochin are going to significantly add to the EBITDA margin this year as well as we go along.
And sir, how are we?
40 to 50%, yeah.
And how are we funding this 300 crores worth acquisition, like including both the acquisitions?
We have just explained that the 5-year plan. So we have got a Pune, Mumbai. Pune is 200 rooms. Okay, this year we have about 300 crore requirement, out of which we will pay 100 crore, and our current mutual fund balance is about 70 crores. One. Second is we are also going to have balance the EBITDA. We have got already EBITDA expected about approximate, if I take some turnover, it is a 250 plus. So that is the current EBITDA. So given this and the existing limits of bank which are already in place, about 25 crore pending, so we have a substantial, we can easily fund it from the sources. So that's 70 crore from the mutual fund, 30 is roughly the balance loan available, so it's 100 plus we may be taking and then additional as we will have mutual fund and loan combinations. So combination of loan we may take, but net debt we will remain positive.
So my understanding is you won't exceed 100 crores net additional debt, right?
When you say standalone, yes, we will not increase 100 crore net debt, but I am saying net debt will still remain positive.
Okay.
Zero. Net debt is zero post mutual funds.
Okay. Okay, sir. Thank you, sir.
Thank you. Our next question comes from the line of Sarthak Awasthi from Sea Funds India Private Limited. Please go ahead.
Hi, sir. Firstly, congratulations on the great set of numbers. My question is on Flurry's part. So, my question is on like margin sustainability on the Flurry's. Like the competition is also adding stores, and some e-commerce players also have started their own cafes. So how we are going to sustain margins? I get it, we'll get the top line growth, but how we are going to sustain the margins and how we are going to come up against this competition?
So Flurry's firstly is in a very, very unique position. It is a combination of coffee, confection, and celebration, which is a very unique positioning for Flurry's. It has a very long heritage. It completes 100 years in 2027. So it is one of the most powerful brands in India in terms of its position at the moment. So the brand itself should be able to have a very strong pull in achieving, firstly, the top line growth. And there is no substitute in the world in terms of business to top line growth. That itself will lead to our forecasted EBITDA margins, which are in the range of around 15%. Yes, there is competition, but Flurys is a very, very powerful Indian brand. Yes, it should be able to compete with all the international brands which are coming. Don't forget that at this point of time, now as well as over the next 5 years, our per capita income is increasing from about close to $2,900 right now to about $5,800 over the next 5 years, and that will obviously have an impact in terms of spend of per capita spend, which will substantially increase. Also, India is today almost 60% of our population is in the millennial and Gen Z categories. So the habits are completely changing. It's moving all towards coffee and also towards going out and meeting out and companionship. So all this is going to drive the business. Also, the confectionery and coffee business, these business, particularly the cakes and confectionery and bakery business, is among the fastest growing business in the retail segment. And this business is growing very rapidly at the rate of 18 to 20%. Currently itself, this business is in the range of 18,000 to 20,000 crores, and it's expected to double over the next 5 years. So all this competition would be there, but India is a very, very large market. India is also a very young market, and with changing habits, we should be able to grow faster and also protect and deliver higher margins.
Okay. Yeah. Thanks for this. That was very helpful. Sir, my second question is on what percentage of repeat customers we have in Flurry? I mean, you can give any sort of example on that part.
I would not have the exact data for Flurys in terms of repeat customers. Yes, it is very high in Calcutta. I would source this data for you and give it to you.
Okay. Okay, sir. Thank you so much. And all the best.
Thank you. Our next question comes from the line of Divyam Doshi from Family Office. Please go ahead.
Hello, sir. Thank you for the opportunity. I just had a question. How do margins compare between your owned, leased, and managed portfolios, and where do you see the fastest growth coming from?
The fastest growth always comes from the owned properties. It is owned properties, and as we go to the new properties which are in the luxury segment, which is Juhu property, this Kochi property, and as you've seen the EM bypass and the Pune and Vizag, we have given the ARs are very high, so they take you to the next level of ARR, and also justifies how we are going to have it from ARR shifting from upper upscale segment to a luxury segment, and which will give to a substantial margin. In terms of the lease properties, we are now ARRs will be range of between 5,000 to around 4,500 to 5,000. But there, what we have, like these 4 lease properties, we expect a stabilized revenue next year, roughly about 20 CR. on which we would expect the minimum 40 to 50% of the GOP level, and let's say EBITDA will be the margin will be roughly about 20% to 25, 20 to 30% net of lease rentals. So that's there. In terms of management contracts, what happens? These all properties will give roughly 60 to 70 crore of the top line. So of which about 6%, 5.5% to 6% will be the management fees, and out of which will be about 70% will go toward the flow through to EBITDA margin.
Okay, so and my last question is, could you detail the capital allocation priorities for the financial year 26 and the financial year 27 also, given the ongoing acquisitions, renovations, and development pipeline?
See, yeah. So current year estimates are around about 300 crores of the acquisition, which will be going towards 160 roughly towards the Jew property, and 300 this year, 300 roughly next year. 600 crores, they will be going towards the Jew property, which will be about 206 crores, and around about 60 crores toward the acquisition. And then we have about estimate about 50 crores will be towards the EM bypass, and Vizag which will start, and Pune will about be again 75 crores. Then remains in EM bypass also, Kochi is 60 crores. In EM bypass, we will also have a net cash inflow by next year. We will have about 140 cash inflow also. So that will be subtracted. By that time, we also have and the current properties we have got capex target of average refurbishment target of 50 crores. 2 years will be 100 crores. Tourist will be about 70-80 crores. So in that way, now you can say 600 crores IPJ breakup. Now funding comes through EBITDA, which is about more than, even if I take the last year or current year's expected target, it will be more than 500 crores to 550 crores is the EBITDA. 550 crores is around about EBITDA, so it's covered through that. My current mutual fund balance is 70 crores. Lines of credit for short term available is also 25 crores. That becomes 100 crores is also available. If required, we may take some short term lines of credit, which will be hedged against the EBITDA available per annum, roughly about 250. And next year, if I add, it will be around another 20% addition on that. So we are free hedged through the EBITDA. But we may take required speeding of the growth. We may take some to push up the growth through some line of credit.
Yes, sir. Thank you so much, sir. Thank you for the opportunity.
Thank you. Our next question comes from the line of Anil Kumar Sharma, an investor. Please go ahead.
Sir, good afternoon and congrats for the good numbers. So my question is, when as you are saying, 200 flurries will be there by the end of next year. So after 200, what will be our net profit margin? What do you expect from those numbers after 200 are stabilized?
We expect the margins to be always in the range of 12 to 15%, because this is how this is considered to be leading margin, and we are all the time working to give to our shareholders leading margins in this business. So as we said that we are going to stabilize these fluorides business. For each outlet, our goal is that each outlet must deliver a minimum of 1 crore, and we are working towards this. Last year we had roughly about 64 lakhs. So we plan to take it midway during this course of this year, and that by next year we should be able to deliver 1 crore per store. So 200 crores, we should be able to give 12 to 15% on the EBITDA line.
EBITDA margin. Right.
Yes.
Right. Thank you, sir. That's my best wishes.
Thank you, Anilji. Thank you.
Thank you. As there are no further questions, I now hand the conference over to the management for closing comments.
So thank you so much. I would like to thank everyone for attending this call and for showing interest in Apeejay Surrendra PARKHOTELS. I hope we have been able to answer all your questions. Should you need any further clarification, would like to know more about the company, please feel free to reach out to us or to CDR India. Thank you once again.
Thank you. On behalf of Apeejay Surrendra PARKHOTELS Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.